One of the things that can typically happen that you're not expecting is have an expectation breaker. So this DeepSeek AI China situation really created some pandemonium in the market. But you can see when you get a movement like this, particularly when you have a leader, that you must immediately sell so that you can reduce, the losses that you have. If you want a triple digit winner in an individual stock, and I think we had 3 of those last year, you got to use defensive selling techniques and tactics to stay in there. Stay in there for the majority of the move. If you're, offensively selling many times, you're only going to get a sliver of the overall gain in the position.
We never want to lose more than 1% on a trade, 1% of total equity. And so what that allows us to do is, in this environment where we're taking smaller positions, it just gives us a little bit more room in a choppy market to deal with those things and not necessarily, risk even 1% at a 10% loss on a 2.5% position.
We illustrated where we actually bought this position on this key reversal. This particular stock had triple digit numbers, triple digit earnings and revenues. When we bought the stock back, you can see it was in this nice uptrend after an earnings report in May. That's where we put this position on. You can see where the stock rebounded modestly and then broke the 50-day. And we sold this stock on the second day of the break of the 50-day. And of course, by selling, you miss that 60% downturn after you sold.
Hey everyone, welcome back to another episode. As always, we bring top traders, US investing champions, and market wizards here onto the show to share their journeys, their strategies, the mistakes they made throughout their careers, and key learnings that they want to pass on to you guys to save you time, save you money, and improve your performance. We've been lucky enough to hear back from many viewers over the past few years about how much of a positive impact this podcast has had on their trading journeys, and we're incredibly grateful for all the support. If you're looking for a free, quick, and easy way to give back to us and show us some goodwill, please double check that you're subscribed down below. And if you aren't, go ahead and click that button. This helps us out in 2 ways. First, it lets YouTube know that this is a valuable resource and it'll push it to a wider audience of traders. And 2, it allows us to reach out to bigger and better guests in the future. So thank you so much for your support in advance. Also, go ahead and click the like button if you haven't already. And if you have any suggestions for traders you'd like us to bring on the show, also let us know down below in the comment section. And with that said, thanks again for your support, and sit back, relax, and enjoy. All right, welcome everybody back to the TraderLion podcast. I'm your host, Richard Moglen. Joining us today are 2 excellent guests. We've had them on before, and they're extremely experienced, both Roy and Wes Maddox, chief market strategists and chief technical strategists and portfolio managers over at IFS. And today we're going to focus on sell rules, position management, really the really important second half of a trade after that entry point that isn't really talked about enough, and I think is so critical to achieve triple digit returns, which is what they're focused on. Incredible performance. So Wes, Roy, thank you guys so much for being back here and looking forward to this. Thanks so much for your time.
Our pleasure.
Yeah, awesome. So Wes, I know you want to kick things off. I'll hand it over to you, and we'll jump through and hopefully cover this concept holistically.
Sounds great. Yeah, thank you, Richard, for having us again as a guest. We always love doing this with you. And I think you made that point very importantly that, everyone focuses on buying. That's the fun part. That's where there's less anxiety. The anxiety comes from selling, and, you can reduce that by having some seller rules and doing things, offensively and defensively. And we'll talk about that right now. And as we were just discussing earlier, it's a good time to discuss that. Yep. You may have to be taking some losses on things right here with some heavy selling in individual stocks, but you have to do that to fight another day, and that is part of the process, as you mentioned, for achieving really strong results. So, we look forward to talking about this and illustrating some things that we've done recently as we have managed our portfolio for clients. There's always room for improvement, as always in this, and it's always an imperfect thing, selling, but you can either sell too early or too late. So it's one or the other. It's never going to be just right. So we'll go through some charts though, and talk a little bit just about general good selling principles that we found helped us.
And just to jump one more thing, and I think people think that big winners just take care of themselves, but I think you guys know that that's simply not true. You have to manage drawdowns. You have to manage things in context of what the market's doing, what your other position is doing, and this is what becoming, an experienced trader is about. And to have a big winner that makes your year, or makes your couple years, you have to manage those winners with tactical rules that I know you guys are going to talk about, for both from a swing trading as well as position trading perspective, because I know you guys do both for your clients. So yeah, let's dive right in.
Yeah, that sounds great. So just quickly, we'll mention some disclosures that we share with people. It's for entertainment. Please consult your financial professional for financial advice. And this is just stuff that, for research that Roy and I have done over many years. And just to give you people on the podcast a little bit of background, I'll go through quickly. Roy, my father and co-portfolio manager, we manage a portfolio at Integrated Financial Strategies. He's been doing this for nearly 4 decades. And we host a Charlotte Investors Business Daily Meetup group monthly on Zoom. So, please feel free to look us up on that as well. I'm a co-portfolio manager and have a background in equity research, and joined him in 2022. So have been, co-portfolio managing for the last 3 or so years with him. And as I mentioned, just a quick plug, there's our meetup group. There's a link there if you wanted to follow that and join us in the future. Again, the second Tuesday of every month. It's open to everybody. We just share our thoughts. We'll talk about what we're holding, what's on our buy list, and overall thoughts on the market. So please take a look.
We'll put this link down below in the description for everybody if they want to check it out.
Okay, wonderful. Okay, so I just wanted to go through a couple of anecdotes. This is from William O'Neill's How to Make Money in Stocks, which is in Richard's background, and I think in my stack behind me. And it's really what all of our philosophy is grounded in. And this is the turkey story, and maybe you are or are not familiar, but I'll just go through a little bit about this. And in this story, there's a little boy who encounters an old man trying to catch wild turkeys using a simple trap. He uses a large box with a hinged door, held open by a prop and attached to a long piece of string. That old man scatters a trail of corn leading into the box, where there's an even larger pile to lure the turkeys inside. So once the turkeys enter, the old man can pull the twine and shut the trap door. However, he can't reopen the door without approaching the box, which would scare off any turkeys still outside. So one day, the old man traps several turkeys, but before he can secure them all, a few start to wander out. He hesitates, hoping more will come back in that, or that he can catch the perfect number. As he waits, more turkeys leave until only one remains. He tells himself he'll quit either when that last turkey walks out or when another walks in. And in the end, that lone turkey joins the others outside, and the old man ends up with nothing. And so the lesson, of course, from O'Neill that he draws from this about the stock market is acting decisively and holding on too long out of greed or hope for a bigger profit, or failing to cut losses when a trade goes wrong. And the old man's indecision and desire to maximize his catch mirrors how investors can lose everything by not locking in gains or exiting bad positions at the right time. So this is why O'Neill in his book emphasizes having clear sell rules that are reasonable profits or cutting losses quickly. And it's important to minimize that emotion that might take over during those selling periods, those troublesome selling periods. So that's an important anecdote. And I'll just go through one other because he adds these two in the same chapter.
He likes his anecdotes.
Do you know these? Yes,
yeah.
Richard.
These are great.
The red dress story, of course. So picture a boutique owner who decides that they want to sell red dresses, green dresses, and yellow dresses. And the red dresses sell quickly. Half of the green dresses sell quickly, and none of the yellow dresses sell. So what would you do? Do you think the yellow dresses don't seem to have any demand, but I still think they're good? Besides, yellow is my favorite color. Well, maybe yellow's out of fashion, the price is off, or the timing's wrong. Those dresses pile up, collect dust, while her money's locked in dead stock. She keeps thinking they'll sell eventually, but they don't. And meanwhile, she misses chances to pivot to what's hot, those red and green dresses. And her business takes a hit as a result. This is obviously common sense in any retail business, so why not in investments as well? So, basically what we're dealing with stocks is, cut your losers quick, buy what's working. And to sum it all up, we say, the key to investment success is quit counting turkeys and get rid of your yellow dresses.
Perfect.
Okay, and so next we can get kind of into the meat of this presentation, and we'll talk about selling, right? What we're here to talk about, selling. And basically, the all-encompassing dichotomy is you can sell offensively or defensively. And so we'll talk about a few different things that we've seen in charts and a lot of examples. Offensive, we'll talk about key reversal days. There's a lot of timely examples that I'm sure, that are real important in the last year. It's particularly important when we've noticed with these leading stocks that are doing that, because every stock doesn't top at the same time, but the leading stocks have these key reversals that have been very, very important. Nvidia, MicroStrategy, and SMCI are just a few examples that that come to mind, right, where things were getting climactic, and the environment changed notably when those key reversal days took place. So they're very important because of the implications for the rest of the market. Something also that occurs around these times is the indexes can be extended, and a lot of times we look at extensions from the 50-day moving average in the index to give us a clue that maybe we need to at the least stop buying, but perhaps selling offensively there. And we'll talk about how those leading stocks were also extended from their moving averages. So back in my research too, an 8% extension is somewhere near the 90th percentile in extension for the NASDAQ. So, that's kind of a warning sign that we're getting in that, near term, extended riskier environment. There's also profit targets. So the classic IBD says you can take most profits in that 20 to 25% range. That's a good example. But you want it to be ideally a multiple of risk, right? So that can change depending on your time frame and everything like that, and the size of your trades and different things. So we really want to have that multiple of risk, and we say maybe 8 to 10% profit loss, and that allows you to be wrong enough times and not ruin your account. And by the way, the way we quantify it in our own portfolios, or in our client portfolios, we say we never want to lose more than 1% on a trade, 1% of total equity. And so what that allows us to do is, in this environment where we're taking smaller positions, we might be initiating positions with 2.5%. It just gives us a little bit more room in a choppy market to deal with those things, and not necessarily risk even 1% at a 10% loss on a 2.5% position. So that's just one other thing, but that we implement to in different environments. But the other type of selling we'll talk about is defensive. So that's the environment we're certainly in right now. We've had a real swift pullback in these IBD 50 stocks that we look at. And why do you sell defensively when you're down? And the risk is, of course, these things can rebound, and they might rebound sharply. We'll see in the next 3 to 5 days. Who knows? But you sell because it's an insurance policy. And what we've been attempting to do in this is force feed capital into winners. So in the last month or so, we've been sort of in a shotgun approach with a number of different stocks sort of working and some not, and being kicked out of some, and then trying to push our money into the things that are working. And so when you can do that, it forces you into the leaders. And another defensive approach might be breaking moving averages. So we'll see that you break the 50-day. We think that's important, especially on volume. And we'll show some good examples there. And again, that kind of depends on time frame too. Another time frame we look at is 2 days below the 21-day. That's sort of our intermediate term support line that we're looking to hold for some stocks. And then, trailing stops, which we don't fully implement because we can't do that necessarily mechanically at our size. But that's, something that I know is common for defensive selling. So you can lock in 50% of your profits, perhaps. There's a lot of, I think there's sell functions on your broker accounts that can do that. And then the fourth, defensive sell, I'm calling just abnormal action. It's kind of the all-encompassing what's going on. There's a headline. I don't know what happened. And, our philosophy has been to sell first and ask questions, figure out later. Because as we'll see, a lot of that DeepSeek, as an example, news, that's what a lot of people did. And for some stocks, it was right. For most of them, it was right to do. For some, we might be a little bit higher as people have done their research and tried to figure out the implications. But abnormal action, we don't really care to figure out exactly why, because we just want to, we don't want to have something blow up even further on us. So that's the all-encompassing rest of defensive selling.
And a quick question for you guys while we're on this slide. I think this breaks it down perfectly, and we'll get into the specifics of each of these bullets, I'm sure. For the amount of AUM that you guys manage, what kind of mixture of offensive versus defensive sell rules do you guys use? Is it more leaning on the defensive, and probably it's a little bit different in your swing trade portfolio versus your position trading portfolio? Just thought I'd throw that out there so people can kind of relate to their style and how they do things, which one they might want to lean more into, offensive or defensive.
Well, yeah, I'll chime in first, and Roy, you can add in. But I'm thinking about the last, let's say, 6 months. It's been half and half, really. I think. The way we navigated things from November through September to December, there was a lot more offensive selling where we went, I'll point on a chart here where we went to 95% cash in December offensively. And then now we've been, while we've been trying to build positions again, we've been forced defensively to sell. So it depends on that. And I'll say, we're forced to sell defensively in our longer term account where we hold things into earnings, if we have a profit. Whereas I would say in that swing trading that we do, I constitute that selling as more offensive because Roy's taken a lot of those off the table ahead of earnings that have profits too. So, it certainly depends. I found that, selling offensively suits my temperament a lot better. Just, you realize that through experience, it ends up better. The results end up better.
Right.
It seems, even if you're selling a little bit early, but there's certainly a mixture depending on, the environment that we're in. So
yeah, makes perfect sense. And Roy, anything to add there, or I think that sums it up pretty well.
Yeah, let me just point out that if you want a triple-digit winner in an individual stock, and I think we had 3 of those last year, you've got to use defensive selling techniques and tactics to stay in there. Stay in there for the majority of the move. If you're offensively selling many times, you're only going to get a sliver of the overall gain in the position. If you're taking, 10 or 15% profits. But of course, the context in the market will dictate how much offensive you should do versus how much defensive selling you should do. But and my personality is I want to hold for those stocks that can turn in to really true market leaders that you explore in the model books that you guys have been putting out year after year. So the only way that you can achieve,
got one right here actually.
There it is. The only way that you're going to achieve those types of returns are hold through various corrections. And so we employ defensive selling techniques when we're trying to hold on to those true market leaders.
That's a great point. Yeah, that's a great point. That exactly. You are only going to get that 20% move, probably, right, if you're too offensive. Okay, so I'll move on here. I just wanted to add in this brief period before we get to real sell rules on individual stocks. But we just this is something we talked about with you in the past. I think at your TraderLion conference, in June or July, and just so please look that up again if you want to see what market tops look like. We don't know ever if we're in a market top when it happens, but we talked about this in 2022, this signal, right? There's the NASDAQ. It broke the 50 on volume. The 10-day crosses below the 21-day. We consider that, and that gives us pause where we are now too, versus, to just plunge in, because we don't know if it turns into something worse. But based on the action, this is the break of the 50 is the precursor to a more prolonged bear market. So we're getting some conflicting things here potentially that we can go through, but so that we do care about the index trend. The index trends have weakened considerably, and so we're very aware of that. Leading stock action is what gets you out first. Many of these stocks peaked and have had real sharp pullbacks as well, and have forced us to get out anyways. But we just think the M in market direction is super important. Yeah, we just wanted to touch on that, and I'll mention a few stats too that I think are very interesting that me and Roy were talking about earlier today. But here's that NASDAQ today, right? And just an idea of that's not all that different from what we saw at the end of 2021 to where we are today. And we don't know. No one knows what we're going to do. Maybe we go down to the 200-day like we did in August, perhaps. But this has forced us to be defensive right here, because the action has not been favorable, and the index, if they're not in an uptrend, most stocks are not going to be acting too well either. So we wanted to provide that context, and just maybe a shout out to the prior videos if anyone wants to look at those from your conference with us. And then briefly too, I want to talk about the FFTY in that same kind of idea. We were looking at these numbers and realizing how sharp this decline has been from peak to trough in these last 6 days. And this is about a 19% peak decline to trough. That's among the worst 6-day stretch in the history of this index. And you'll see I have this table, which of course, this is clustered around here. These are 6-day declines from high to low in the FFTY indexes. And of course, it's clustered around 2020 because there were several very, very bad days. And I don't know what the total peak to trough was in that index entirely, but just to give you a sense of the swiftness, in 6 days, we're down 19%. That happened in 2020, of course, several times. And then in 2022, it happened once on June 16th, where it was about the same peak to trough decline. So I want to look at that again. Here we are, FFTY in 2022 or 2025. But in 2022, here's that time. Okay, horrible decline, but the selling does relent slightly on June 16th of 2022 for the FFTY. And then the S&P 500 on June 16th, you'll notice how meaningful that low was as well. So I find that, extremely telling that we just had a really, this has been a very ugly pullback in the, underneath the surface. While I know the S&P might be 2.5% or so off the highs. So last time we had that in this sort of high momentum, type of stocks, it was a meaningful low that's setting in. And, we know the catalyst is coming perhaps, right, with Nvidia coming up, earnings tomorrow, and maybe that's what puts the low in. We'll see. Who knows, right? We'll see how everyone just wants to see how the market reacts. But that was a super meaningful low, and we only briefly undercut that at the low of the 2022 bear market. So to us, that's something positive to consider. And then in 2020, here's the FFTY, on that peak 6-day decline, which I think was from here to here, 6 days of a 27% decline. and that was the low in the FFTY. And then similarly, or just about the S&P, that was not quite the low in the indexes. I think they drifted lower, maybe 6% there. But that's the question that on a time basis, we're probably almost done. You just have to be careful, of course, with those last few days. What might transpire, because that's where you can really get hurt. If you're very long and the indexes are down 5% and stocks are down 10%, that can hurt. So anyways, that's kind of the positive twist to that. The amount, the swiftness of this decline, has probably caught some people off sides, where we had a fake breakout in the FFTY, and then that's the top three decline in 6 days. So that's really it as far as context for me and just general principles. Roy's going to go through a lot of examples here now, and hopefully you guys can enjoy and study some of these, because I think they're helpful. And as soon as you see these enough times, you just realize that's why you follow rules, because they work over time, and that's why we've been able to survive for bear markets and in cycles and tough pullbacks that are unexplained. But so I hope you guys can enjoy, and we'll pass it off to Roy for some of these examples.
Thank you, Wes. Now let's talk about some specific examples in terms of defensive selling and offensive selling. So let's move forward. So basically we've got a precedent analysis. So we're focusing on what's happened in the past and what are the clues to lead you to selling in general. Again, as Wes mentioned before, buying is the fun part. The selling, you're always, in some capacity, you're selling off the top. So, you didn't get quite the magnitude of the move, or you're selling defensively and you've got a trailing stop, or you're protecting your downside. And so you're many times you're losing money from a defensive selling side. But it's very important to implement both of these tactics in terms of your selling, both offensive selling and defensive selling, to be effective in managing your investment portfolio. Okay, we wanted to point out just some of these examples, and this was a reflection of what happened during the DeepSeek Black Swan event just a few weeks ago. And we were actually caught in a few of these names. We had significant profits, but we're showing you and pointing out so that you can see how the stocks looked and how they were performing quite robustly. But then something happened out of the blue. And so one of the things that can typically happen that you're not expecting is have an expectation breaker. So this DeepSeek AI China situation really created some pandemonium in the market. But you can see when you get a movement like this, particularly when you have a leader, that you must immediately sell so that you can reduce the losses that you have. So this is an example where we had a 20% profit and we took a loss by selling immediately when that came out. And these were the power companies. The power companies have had that narrative that our grid is undersupplied, and that these large language models and driving AIs can require an enormous amount of energy. And so these were the companies that were benefiting from that narrative. Vista Energy, again, broke on the news. You could see the stock was in a great uptrend, and then out of the blue, the news came. And so we use this as an example to sell immediately without any hesitation. And when you get something like this, you must sell immediately, because you don't know if the stock is going to get cut in two from the period where you sell it. Many times the news is unclear, but the price action dictates that you should reduce your exposure.
And on a day where this happens, what's kind of your mindset in the morning? What's kind of your game plan? I know some traders might watch, a few minutes and then decide to cut it, or do you just kind of cut it right out the open to limit any further downside?
We've actually maneuvered in both of those situations. We've sold right on the open. Others we've let the stock base a little bit, for 20 or 30 minutes to see if we get a rally. We'll
Right.
show you two examples. In
Perfect.
this case, we sold immediately because we didn't know the impact and we were unclear in terms of the impact. But these were situations that we sold immediately because we wanted to stop the bleeding, immediately. And we had 5% positions in these names, so it was important for us to just reduce the drawdown.
Perfect.
VRT, of course, they're right in the middle of the expansion and the data center area. So this was clearly a leading stock from a 52-week high, all-time high, to just getting crushed. We sold this immediately on the open as well. You can see where you can't worry about if the stock's going to rebound because you don't know if the stock is going to rebound or not. You can see if you sold this on the open at 115, it did retrace quite a bit of that, but you never know. And you can see what's happened, of course, in the last 2 weeks. It failed there on the rebound, and now it's making new lows. ALAB was another one. This is a company that had triple-digit earnings and revenues for the last 4 quarters. Perhaps one of the strongest fundamental situations that we were following in the market. And you can see how it was blasted on the AI news. And we exited this as well on the open. CRDO, another example. You can see that these were the leading stocks in the FFTY, leading stocks in the market. Almost all growth managers and growth investors own these particular stocks. And when you're, of course, when that happens, that leads to a very crowded situation and a crowded trade. And, everyone's trying to exit the door at the same time.
And these gap downs are all really good examples of what Wes was talking about earlier, the abnormal action that you want to be looking out for. Just large gap downs, like you said, from 52-week highs to, down 15 to 20% plus in just a day. That's suggesting that there's something not quite right, and you just have to reassess and manage risk and protect your capital as best as you can.
And notice, Richard, here that, if you're lamenting the fact that you got caught in a situation like that, if you were lucky enough and if you were quote, a gambler, which we're not, you can see the stock bottomed at 51.80 and you had a remarkable rally all the way back to 83. But after doing this for almost 4 decades, most of the time, I would say 90% of the time that you have a break like that, you don't have any retracement. You just continue to flop and continue to flounder. That's why it's so important when you have these expectation breakers that you like to call them, Richard, that it's time to just exit the positions. CEG, it's not one that we owned, but we're just illustrating this for educational purposes, the same type of horrible action. And you can see that you bottomed, rallied up, and obviously in retrospect, those provided excellent shorting opportunities, but we don't short very often. When we do short or hedge ourselves, hedge our portfolios, many times it's just with inverse ETFs. So we don't normally short individual stocks. CAVA, we wanted to just point this out. And we actually, between CAVA and APP, these are they were two very important stocks that were leading stocks. And we wanted to point out the buy point, on these stocks where the stocks were in a correction in that August bottom. And you can see that from that August bottom, and Wes pointed out the FFTY where we had that 19% drop during that period of time. And you can see that once you had the low in the market, then you had the leading stocks moved powerfully and quickly. And in this particular case, you were below the 50-day moving average. You popped above the 50-day moving average, really warranting an early entry on the particular stock. And we didn't participate then. We just let this one go, probably because the correction was so dramatic in August that we weren't so quick on the trigger to get back in and pile right back in. But this is one that worked beautifully until you had the sell signal, the defensive sell signal. You can see up there where Wes has annotated it, where we had abnormal action, broke the 50-day, which was a clear defensive sell signal. Now, just to point out, and we're really not talking on this podcast about the buys, but we did actually buy this stock back, breaking above the 50-day. And when it corrected, 5 days ago below the 50-day, we took our loss. So we used the same type of tactic in terms of getting in, and then we got quickly out, breaking the 50-day, on volume.
And with this CAVA, if you go back, sorry, Roy, they had that earnings reaction, that 172 bar where I think it opened right near the high there and then sold off basically the entire day. That to me is kind of an early warning sign as well, just to be on guard. Maybe you don't sell your position depending on where you bought it, but just that's a little bit of maybe an offensive sell signal or just something to take note of, to be more prepared to be defensive in the future.
Richard, we point that out precisely on an upcoming slide, that type of action, like you said, that is really an offensive selling signal right there. It's clear as a bell, obviously, when you look in retrospect. But anytime you get a situation like that where you have a huge move up and then it's sold into it the entire day, that's the time to presumably take the stock off your list. And we will show this and illustrate this in an upcoming slide. Great point, Richard.
Yeah, sorry to jump the gun there.
No. ServiceNow, we didn't own this stock, but we were watching this stock because it was heralded as one of the enterprise leaders in the AI space. And this AI space, it's so it's loaded with so much optimism and so much productivity gains that are going to be coming, that it clearly is a market that has the world's is its addressable market. So that's what makes these stocks so powerful, is because the thematic narrative is so powerful. But we wanted to point out here's the abnormal action. And the stock broke. We didn't have a position on this, but that was an earnings disappointment. So many times when you have a defensive selling, it's because earning disappointments or some other news that's unexpected. And again, we wanted to point out on all of these charts that you can see where, okay, if you own the positions, looking back, those were situations where you shouldn't have held the position. You certainly shouldn't have bought more of them. And in many cases, they work just like this, where they bottom, go sideways, and resume their downtrend. That's why it's so important to sell these immediately when you're disappointed. TMDX is a perfect example. We illustrated where we actually bought this position on this key reversal. This particular stock had triple-digit numbers, triple-digit earnings and revenues. When we bought the stock back, you can see it was in this nice uptrend after an earnings report in May. And we had been watching and monitoring the position. That's where we put this position on. And you can see where the stock rebounded modestly, and then broke the 50-day. And we sold this stock on the second day of the break of the 50-day. And of course, by selling, you miss that 60% downturn after you sold. So imagine owning a full position. For us, that's 15% in our swing trading accounts and 7.5% position in our core accounts. Imagine having a 15% position that you let drop an additional 60%. That's tough to make up in the whole scheme of things. And it also illustrates how important it is once you get these key sell signals to just sell and let the dust settle, and then see if the stocks rebound or not. That's why it's very dangerous right here, Richard, to guess the bottom in the market. We're currently about 15% invested in our swing trading accounts. So we've got 85% cash, and we're 70% cash in our core accounts, currently.
Yeah, just for everybody watching, for you guys' reference, we're recording this on the evening of February 25th. We just had, as you saw with Wes's slides, 3 sharp down days in the market. And then, as we saw with FFTY, a major pullback. So that's the context that we're talking about today, everything we're talking about today.
Well said, Richard. Of course, this is ON Holding, the footwear company. And you can see this is where actually we bought this stock earlier this year, breaking the downtrend line. You can see the clear break of the downtrend line, which provided what we view as an early entry. And you can see where the stock peaked and then had some gyrations. This is, Richard, one of those examples, see, where it broke the 50 intraday in the morning and it came all the way back. Mm-hmm. So this is one of these situations where we didn't sell it like on the open. I forget what the news was, but we didn't sell it on the initial break, but we did sell it a few days later on a break of the 50-day for the second day.
Mm-hmm. Yeah, and Roy, I was gonna make that same exact point. Precisely, it's a little bit of a less liquid stock, so I think that's part of why we didn't want to sell it immediately, on that break of the 50, because you can't always trust the quote that you might be seeing pre-market, let's say on a relatively thin company, honestly. And I think that news may have been Decker or Skechers or one of those two, but that's a great point why we don't. We prefer to let these things close because we kind of view that close as the most important price of the day, but you don't always get that opportunity.
And again, remember the red dress story, that we are involved in all the red dresses. Like, we're looking to find the true market leaders, the biggest percentage gainers that we can get our hands across and get our hands around, and hold those for 3 or 4, 5 quarters where the company beats and raises their guidance. But in terms of trying to find those, you get shaken out of many of the wannabes. And so that's why when you get shaken out, it's just insurance. It happens in the normal scheme of things. But imagine, again, the selling that takes place, you must really have some type of rule to reduce your loss and not ride these stocks down, 30, 40, 50%. This is a perfect example, and we held this stock. We're showing you just a number of stocks that we actually own. We didn't own a lot, every one of these. But we did have, there are a number of these that we did own, and we wanted to point that out so that you can see that as well. We held this stock into the number in our core accounts because the numbers that Wall Street was looking for were astronomical. From the analysts that we follow, they were providing excellent visibility and guidance going into the quarter, and the company just did not deliver. We did not sell it like right on the open there at 60, but we did sell this stock on the rebound, probably got out the first hour at the 65 area. And you can see the stock is sort of meandering around right now. You can notice where the stock broke out during this earnings period in this great uptrend. And then, of course, you just had a disappointing reaction to the number.
And one question on this one, and maybe kind of a general question too. Say you've got a position going into earnings, just like you had with Roblox. Does how the stock act going into earnings affect your decision about whether to hold through or not? This one obviously is an example of a stock that had a very strong uptrend going into earnings. Sometimes, a stock is basing, sometimes a stock is actually pulling back into earnings. Is that taken into account into the equation at all, or it's more just about, what your profit cushion is overall and what the fundamentals is?
It's more about the profit cushion, Richard. Mm-hmm. And we also want to explore the context of where, what's happening right now. Are there a lot of breakouts that hold? Or are there many breakouts that are failing? And in this particular case, breakouts were working. We were very, very bullish at the beginning of the year, had nice profits built up, and then you were totally, totally surprised on the earnings report. But what we think is important is your position size, and that should be managed according to how much profit you have, mm-hmm. and what might be the worst case scenario, going into the number. Right. Rarely do we ever hold a position more than 5% going into a number, regardless of how much profit we've got. Because we have found that in many cases, you can get into the position on the new uptrend after the earnings report, even if it gaps up, that can still provide, an excellent opportunity to add to the position. So in our swing trading accounts, and I'm sure you have a lot of people that are following TraderLion that do and conduct swing trading as their strategy. Rarely do I hold a position into the number, regardless of the profit that we've achieved. But we do tend to hold and try to hold stocks in our core account. But again, we sell off. We will take profits going into the number, and rarely do we ever hold more than a 5% position into the quarter.
Yeah, that's helpful. Thank you.
Shark Ninja, you can see, and this is an interesting illustration. And again, what we're trying to do is discover those true market leaders that TraderLion's model book has just previewed every year since they've been designing the model books. And you can see how this is the type of stock that had a terrific uptrend. And you can see where we bought it, where we have annotated that there's where we bought it. But notice here, Wesley pointed out, well, this was the buy, the better buy. And that better buy came right off the August bottom. So think about how important it is to not give up, even though growth stocks have been mauled over the last week recently. But notice this stock was setting up so that as soon as it made a new 52-week high, and that's right coming off the bottom in August. So the next leading stocks are going to have powerful moves if we bottom today, if we bottom, the next 2 days after Nvidia, after the PCE report. Watch to see those stocks that can immediately go to new high territory. It took us a couple of weeks to get on board in Shark Ninja, but you can see the better buy was the ones that had explosive action right off the low. And notice the volume confirmation at the bottom as well.
Yeah, this looks like one of your 10% gappers on big volume that I know you like to run that screen.
That's right. So it's one of these stocks that had that 10% or more up in price, where volume was up over 300%. And you could see coming out of the base. So it wasn't really extended at that particular time. So that was an excellent time to initiate the position. And there's the earnings disappointment that the stock experienced and the subsequent sell-off in the stock. That's where we were totally out of the entire position right there. Twilio, here's Twilio, which was a leading stock, one of the Cathie Wood stocks that rebounded significantly. They beat and raised their numbers for the quarter, and you can see there was a big breakout during the Analyst Day where they gave guidance, and then a few days later the stock got ripped apart when the guidance wasn't as good as expected by the street. And so this is one that we had a very small position, maybe 1% going into the quarter, and we liquidated the position in the swing trading account before the earnings were reported. And this just shows you, Richard, that the earnings that you expect, that you have no idea if they're going to be good or bad. It's been our experience that it's really 50-50, and there's just no way of getting around it. Everyone's going to have a different tactic in terms of how they treat earnings. Some people hedge and they write covered calls on the position, and that's probably one of the most effective ways to reduce volatility and risk, but you give up the upside when you do that. So I think the better example, depending on the profit cushion that you have, is to either be out going into the number or hold the position going into the number and be rewarded with a great earnings report. GLBE, we don't own this position, but again, this is how the stock was presenting itself on the charts, and there's the earnings disappointment. And so you could see that, wow, this stock looked terrific. There was absolutely no hint that they were going to have a bad earnings report, and so that's what occurred in this particular case. And you could see how important it was to sell immediately. And when you got that bad earnings report, and conversely, these are if you're inclined to short, these many times do present excellent short candidates. Those stocks that miss and lower guidance, typically those stocks go lower in price, while the stocks that beat, raise guidance, and that have institutional support and that are favorites of Wall Street, those typically go higher, particularly in the most liquid names. So notice how much you would have sold, selling it at 50, 58, all the way down to 44. You would have avoided that last, 35% drop in the course of just a few days. So that's why it's so important to sell defensively. Axon, analyst downgrade. Notice the break higher on that earnings report. So the stock is showing you that it's a potential, true market leader. You did have that correction, and again, you had the analyst downgrade as the stock came up and provided this, I guess, punch bowl of death type of scenario, but it was downgraded. You can see the erratic action right there, which was your sell signal. And I believe these guys reported after the close today. I think the stock was up after the close, but there's no way that you could hold a stock breaking support through the 50-day, because that was at 600. You don't know if it's going to 450. You don't know if it's going to 400. You have no idea. And yet the stock did report again tonight, and it's up 12% on their earnings report, and that changes the complexion and complexity of the stock now. So after the market, they did have a good report, but based on the overhead resistance, you're going to probably run into a lot of selling with this overhead as the stock bounces back up to the 50-day. It's a broken stock now with heavy supply above it. So that would be very dangerous to buy on the bounce in the morning on the open.
Yeah, and I was actually going to ask that question, Roy. Comparing this gap up, which we're expecting tomorrow, in the context of that sharp decline versus the one it had in August, not even the recent November one, but the August one back in the middle of the screen there, where it's coming out of a mature base where it just chews through that supply and immediately starts a trend. Those are completely two different gaps that you're dealing with. One is actionable, one needs to prove itself a lot more in kind of my view, and you probably feel similar.
I do. Well said. Okay, four systems. This just happened a few days ago. You can see where the stock broke out, and then you had the disappointing bad reaction to earnings. Stock's making a 52-week high. It's hitting everyone's screens. Looks like they're going to have a great report, and they gave disappointing margin guidance in the stock, and you can see the subsequent drop in the stock. And there's, again, the defensive place where you should have sold the stock immediately, and then it led to further downside as well. When you're in these situations, if you can keep the break to 10% or so, 10 or 15%, that's not going to be devastating. But once you let these stocks go down 20, 30, 40%, you're digging out of a hole. And for the readers and viewers today, we're trying to point out that many times it's important to sell first and ask questions later based on the market, what the market is saying, not what someone on TV is saying or an analyst is saying, because certainly many times analysts are reiterating buys as the stock goes lower because they think the stock is more attractive as it goes lower. And from our perspective, the stock is more attractive as it goes higher, not lower. So it's a matter of your strategy and your methodology. The only way that you're going to have a stock that goes up 100, 200, 300% is it's got to be making new highs in price. And that's why we are always looking at the new high list to explore stocks that we're missing or to identify the leading stocks in the market. In RDS, you can see the abnormal action. This is just something we were just saw on our sheets. We didn't own this position either, but you can see the abnormal action, the break right there off the top as it was putting in that cup, trying to put it in a cup and handle formation, and the abnormal action and the downside follow through. Many times when you have an initial break, it's really, it's not the first break. Normally there's not just one cockroach right in the room, and you can see that it cascaded down over the last 3 or 4 days, as it's certainly an inferior, lower quality stock. But you can see the technicals gave you a clue earlier that you should not have been in the position. A UNH, there's, this was a defensive stock that was actually holding up there in December, making 52-week highs. Of course, unfortunately, the CEO was murdered there in New York City, and you had the big break of the 50 on large volume as well, which corroborated the fact that that the stock was technically weakening, and that was your exit point if you were actually in it here, say at the 570, 580 area, followed by really sort of a powerful climactic move down, a rebound. And then you can see 2 days ago, the SEC launches an investigation for Medicare Advantage fraud. So the first breaks that take place, that was your exit point. It never gave you a proper base or setup, or it did not set up again in terms of getting back into the position. It had far too large of a drop to to be held or bought without setting up a new base. And then many times, of course, other bad news comes after the break, and that's what happened in this case. RGTI, a big break. This was really a climactic stock on the upside, and there's the break where Jensen announced that they had sold their position. Oh no, I take that back. Jensen said that quantum computing is going to be 10 or 20 years in the future, and so the stocks had this terrific break because people were piling into this new powerful narrative, and new technology. But that's where the break took place right there. Once these stocks break like that, rarely do they come back quickly. And particularly these stocks, the quantum stocks that had no numbers, like QMCO, QUBC, RGTI, and these stocks are going to take a long time before they're profitable, if they ever will be profitable. And so they're very, very speculative stocks that have really no fundamentals. Just they've got a story and hype and possibilities, but no earnings, which makes them really a no-go zone. FRPT, you could see the break on volume up there where Wes has annotated. And there was the signal. If you're really on your game right there, you would have noticed that. You probably, would have exited there. You had additional follow through a few days later. And again, you can see how it's just collapsed, down 50% from your sell signal. And, there was nothing out of the ordinary in terms of the normal uptrend, pullbacks. Everything was normal until that break happened. And you could certainly see, if you didn't exit it on that first break of the 50-day on volume, that the downside follow-through provided a last best time to exit the position. And you should have exited certainly right there. SERV, this was, again, Nvidia liquidated their stake in SERV. The stock was trying to exhibit some type of leadership, and you can see the break of the stock that it incurred there. And you can see certainly it's a no-go zone these days. Lantheus, another bad break on volume. And you can see one of the prevailing themes is many of these breaks occur when there's a bad reaction to earnings. And so, one must, for himself, determine if you wanted to hold any stock into earnings or not, particularly when you can see that in all these cases, you've had the bad break. We're not showing you the stocks that reacted powerfully to the good earnings because those provide buying opportunities, and we're trying to focus on selling on this podcast. So we're trying to warrant spending time on the stocks and the episodes that occur where you truly should be selling, and not buying. And now we'll go over a few slides on offensive selling. And we just wanted to point out that you can see this is the QQQ, the NASDAQ 100 ETF. And when we peaked in July, that was an extension of 8.7% above the 50-day moving average, which is historically, as Wes said, in the 90th percentile, that the market typically has some type of consolidation or pullback when you get that level of extension. And we also noted where Wes and I moved to 95% cash in December 13th, the day before the 700-point drop in the NASDAQ. And we did that because of the level extension, but most importantly, all the stocks that we owned at that particular time, they were all extended. So all the stocks, we were up in everything, and all the stocks were extended, and that's why we sold everything except IBIT at that particular time. And incidentally, one might ask, well, why didn't you sell like in the last 5 days ago? When could you not have forecasted that? But we were only 3.1% above the 50-day moving average, and it is very, very rare, as Wesley mentioned, that to have a break, such a large break in 6 consecutive trading days. This is among one of the largest drops in history for the FFTY during that particular case. Now, we don't buy the FFTY, but it does serve as a benchmark so that we can, so that we it gives us our temperature in terms of, well, what's the market looking like for growth stocks? And you had no advance warning. Just 6 days ago, that FFTY was breaking out to new highs, showing you that growth is in favor. The NASDAQ, the QQQ, not even extended on a historical basis, but yet you had this powerful drawdown, over the last few days. The NAAIM, the National Association of Active Investment Managers, does certainly provide sort of anecdotal information in terms of when the active managers exceed 100%, and you can see these particular times in the past that those oftentimes results in a short-term top and a pullback. And you can see that's one of the things that we were looking at that December 13th day, where we were 100% in, the active managers were 100% invested. And we just looked at our positions and made the judgment call that active managers are all in. And so that's a time where, where you could and should have reduced exposure. You can see now that we're not at 100%. This number is going to come down on Thursday, and so that's going to be from a contrary perspective, excellent. I did see where the feed greed index was extremely fearful today, and so that's consistent with what we're seeing in all these growth stocks. The levels of fear are really expanding, right here. And, it's, we use the expression that they're really puking a lot of these names. And so that's what happens at the tail end of a correction. That's what makes it so difficult to determine, is this the beginning of the end or the end of the beginning? Is this going to be a great opportunity, in the next 2 to 3 days with fear escalating and stocks have come in tremendously? Are they going to provide great buying opportunities? All we can say is when the stocks that rally, that rebound the most, the first and the most, those are the ones that have the potential to lead the next major uptrend. And these illustrate key offensive sell signals. And these were two investments that we enjoyed a tremendous success with last year. We had full-size positions in both of these, and you could see where we almost got a double the first time, and you had that key reversal signal that Richard mentioned on CAVA. and then we bought it again, breaking back over the 50, and I think made maybe 70-80%, and you had that key reversal signal there at the top. And notice here, way over here in November, that's when the last earnings report occurred for Nvidia, and you had a similar type, early warning reversal signal while the stock was up on the morning. It closed weak, and it hasn't been able to, come back and make new highs. This is going to be a very, very important report tomorrow night, because it is really the straw that stirs the drink in the technology space and in the semiconductor space, which is ubiquitous across the world, across America. And obviously semiconductors are in everything now. And this is the biggest stock in the semiconductor, area. So it's going to be interesting to see if this stock, with all the negative sentiment, if this stock goes to new highs, there's a chance that it might lead us out of this funk and start the beginning of a nascent uptrend, a new uptrend in the market. However, if there is disappointing news, disappointing guidance, and it doesn't matter what the numbers that are reported, what matters is how the stock reacts to those numbers. But this is the stock to watch significantly and closely tomorrow. It's going to probably dictate the short-term movement, in the market and in the averages.
And one thing I've noticed with Nvidia, if you don't mind going back, is
Yeah.
the last two bases it's kind of a base on base here. They're a whole lot choppier than the previous two ones, which led to those really nice moves in 2024. You had that one, which was pretty clean after that orderly drop. And then the previous one was a nice VCP that was like six months long or 5 months long after their nice move off the bear market lows. But if you go to the recent ones, it's just a lot choppier. It doesn't respect the moving averages in quite the same way. And within this most recent base, you have a lot of those downside reversals that you're talking about as well at 152, 153, 148, gap downs, gap ups. It looks like it's changing character a little bit. And then the 200 SMA also has caught up now, which is more kind of stage 3 Stan Weinstein type action. So I agree with you. I think this earnings report matters a lot and could dictate, how Nvidia does over the next few months, whether it acts well or sees some further distribution.
Yeah, remember, Richard, in the 2022 bear market, I think Nvidia dropped 65%, if I'm not mistaken. And notice this is really what you're looking for. You want these beautiful, beautiful, nice, tight uptrends.
Orderly, yeah.
Orderly, and that's really what you're looking for. By no means over, the last 7 months has there been anything orderly about it. Just chop, 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 and there's no consistent, place to buy, and you're just getting, chopped up in the position. So it's going to, this, in 2024 that began, on an earnings move, and we just need to see what the earnings are to see if we start a new move over $155. So if the stock goes to new highs on the report and holds the gain, then you're going to see perhaps a character change back in a very positive way. But if not, this stock could go to 100. We have no idea. This for us we would never hold this stock going into the number based on this market action. We'd rather miss the first 10 or 15% to get the next double than get blasted with a disappointing earnings report that moves the stock down 20% and puts the market under additional pressure. Great illustration here on that offensive sell signal where you had this huge move up. There's your exit point right there. And even though the stock rebounded from that correction of about 40% to new highs, then it has not, its goose is cooked. You do see some buying here coming in and back above the 200-day right here recently. And so, this stock is back in a stage one type formation after Richard mentioned Stan Weinstein's work, which is terrific. You can see this is how you go from a stage one to a stage two, the topping pattern, stage three to the stage four decline.
And by the way, just on this, just because it's relevant today, the bar was so low for SMCI recently. All they had to do was file a 10K. I think they're up 25% because they filed. So that's it. Keep an eye on that one, I guess, if they can, restore confidence in their investors. But, you're right. It might be back in that stage, entering that stage too. But I don't know. That's, ongoing.
This is one that we're fortunate enough, again, to make 100% in the position on a full position. And you can see the key reversal day. That's where we sold on that key reversal day, taking out the prior day's low. And when these stocks go climactic, and our work has shown that many times climactic stocks need anywhere from 9 to 14 weeks before they can go climactic. So if a stock goes up, 20% or so in a short, brief period of time, O'Neill has the rule for holding it, another 8 weeks to get moves like this. But in this particular case, you had that climactic move where you could see where the stock made a massive move quickly, and then followed by the biggest bar on the downside bar, in the whole uptrend. And that's something, that's one way of telling you that the move is potentially over. Tilray had a very similar look like this back in, I think that was in 2021, if I'm not mistaken. But you've got to pay attention to these key offensive selling signals. And many times, once something goes climactic, they take months or even years to come all the way back, because Roy, the character changes change.
Yeah, it absolutely did. And I was going to add just on this, one of the things I remember as we were trying to manage this position and get as much as we could out of it, we may have not got it on that exact high day and then going negative. One of the things we were looking at in this, I remember in this case, was the extension just off the 10-day, because the whole time we're thinking, man, if this, if we can't withstand giving back, and that's where a bit of art too comes into it, right? What's our tolerance? Are we willing to let it come back to the 10-day, and give up 15%? And so that's what starts, ringing some alarm bells for us too. When we think, man, we cannot give up just a normal reaction. It might be time to sell a little bit early. So I'm thinking we may have sold 1 or 2 days earlier. But anyway, it didn't matter. As we said, it's imperfect, and we got a very good move out of it. But just wanted to point out that as well. And something that registered with me on this move for MSTR was that in SMCI in my personal account, I feel like I got the move, but maybe not. I didn't feel like I had enough size, that initial move out of it. And I remember thinking, I tried it again and tried bigger after it had its key reversal, and it didn't work. And I just, when that character change is so significant, like it was with SMCI, I knew with MSTR I wasn't going to try again for a second bite of the apple, because that character change is so significant when you are down whatever that was, almost 25% in a day, that it's just not worth, take it off your list, because it's just clearly, it's been a really difficult thing to trade for 3 months. So that was a great learning experience for me personally, I think in the first part of the year. to take that into MSTR, which was just a great trade. So
Yeah, you see it like a week or two after the key reversal here, that wick at 444, then you see another downside reversal the next day,
yeah.
and then it breaks below the purple MA there. So yeah, I think all this is kind of, if you saw the words abnormal action at the very beginning and didn't quite know what you're looking for, this is another good example to help train your eyes about what a stock changing character from a really strong uptrend to then transitioning to being under distribution kind of looks like. And that's what we're really trying to encompass here with, within the words abnormal action is signs of distribution, wicks, gap downs, big reversals down, losing respect for moving averages, gap downs, all of that, that's all combined into abnormal action.
Richard, we couldn't have shared this more eloquently with you. You're exactly right. And again, one of the things that you just said that resonated with me is we're always trying to train our eye. And so that's what we're trying to do. And so this is just a pictorial representation of buying pressure versus selling pressure. And that's, half of this battle is training your eye. And that was, very eloquent in your explanation.
Yeah, and I just want to reemphasize, I think, Wes, I think you said it really nicely, what you guys were thinking about, if you look at where the 10-day is and where the stock is, and you can't stomach that drawdown, which would be completely normal just to pull back to the 10-day, that's a time to look to sell into strength. I think people are always wondering, when should I sell into strength? What is extended? And I think a good rule of thumb is basically what you guys were thinking about is, if I can't stomach a pullback and give up that drawdown, that's a time to sell some or all of your position just so you can stomach that pullback if it does occur. So I think what you said there is a really good golden nugget.
And you have to also, and we're not talking really alike, about buying techniques, but a lot of times, if the stock is extended, you really should be buying the stock, at the 10-day or 21-day. So, if you're buying it at the 10-day, you've got to look to see how much downside do you have where you would stop yourself out, if it breaks the 21-day. So that's certainly, part of the art.
For sure.
And there's CAVA that Richard mentioned earlier in the conversation. There's the key offensive sell signal to exit the position. And let me see, how is that stock doing after market? Let me see. They reported after the close, and that stock is up 2.5%. So it's rebounded, but it's certainly a very minimal bounce based on the earnings report. So certainly not anything to write home about. And so it looks like it just needs more time to base and go sideways. It's interesting, you had this was obviously one of the leading stocks in the market. Everyone owned it. And then you had that key reversal day, and then it was over. So you've got to, pay attention to these signals and understand what they look like and understand to use these, to reduce exposure when you get a signal that looks like this. SKYW, Sky West, another key reversal offensive sell signal. You can see the stocks in this beautiful uptrend, followed by that correction in August. And again, this is what might be happening on a lot of these stocks. For example, like a Robinhood that's come in dramatically, but then it immediately rebounded at the bottom when the market bottom led to new highs in the stock. But there's your key sell date right there, where you were given the signal to get out. And that's 135 to 95. that's a substantial, decline that you want to certainly lock down your profits and avoid. And again, selling keeps you in the game, including taking losses, which is part of it. Taking gains is fun, but taking losses keeps you in the game as well. And this concludes our part of the presentation. Richard, we want to thank you so much for inviting us. It's always fun to talk to you. We also wanted to point out that we do have a YouTube channel, and if you search for myself or Wes, you will on YouTube, you will be able to find a number of interviews that we have with TraderLion that provides all types of information. We're huge fans of Oliver Kale, huge fans of Stan Weinstein and John Boyk's work. So I think your members will be very satisfied and get a lot out of all those interviews that Richard, that you continue to do and that you continue to bring to the community. So thank you so much for that.
Yeah, of course. Thank you guys for your time. And we'll have all these links down below in the description for easy access. So definitely go ahead, check that out. Roy, Wes, thank you guys so much for your time. I think sell rules, like we talked about earlier, they're not necessarily the fun part of trading. Everybody wants to talk entries, gap ups, all that stuff. But I think managing a winner and knowing how to stick with a winner with both those offensive and defensive sell rules, I think is critical to really take that next step as a trader. And when you catch a winner that can become a Tesla or an Nvidia, if you don't have the rules to manage it, you're likely to sell it too early or too late, and that can make a big difference in making your year or really moving the needle in your account. So thank you guys so much for taking the time to put that together. I think a lot of good charts to study and to go back and train your eyes. To finish things off, any kind of final rules regarding selling that leverage your guys' experience, managing a lot of capital, about key lessons that you've learned. What are the most important takeaways for people to get out of this interview?
One of the takeaways, Richard, and then I'll turn it over to Wes with his closing comment, is it's better to be a day late in buying than a day early. And it's much more important to wait until you see the stock turn at the bottom and be convinced that the low is in than guessing, because if you would have bought any of these stocks, these leading stocks, you would have been buying a falling knife. And it's much more important to wait for the turn and then move.
Okay. Yeah. And one thing I have to remind myself of, I think still, is you can always get back in. Mm-hmm. That's just one thing to keep in mind. There's nothing keeping you in. And even like Roy said, with missing the first 5% up, it's not a big deal. So there's nothing forcing you to stay in. If you're losing sleep or something, get out. Sell. It means you're too exposed. So remember that.
Yeah, perfect. Well, thank you guys again for your time and for walking us through that. I think this is a really valuable resource for people. So hopefully, guys, everybody watching at this point, thank Roy and Wes in the comments. Check out their links down below. Leave a like if you enjoyed and subscribe to the channel. And we'll also have the links to our previous podcasts and conference presentations from Roy and Wes, which I highly recommend checking out. We've covered now, almost the entirety of trading, from market cycles to all of it. So those are really valuable if you want even more, to listen to them even more. So thank you guys again for tuning in, and we'll see you guys in future videos. Take care.